Something is coming. The smartest minds in finance are pointing to the same year, the same window of vulnerability. JPMorgan's economists have issued warnings. Ray Dalio has restructured his portfolio. The Bank for International Settlements has published urgent research papers. Major hedge funds are quietly moving to cash, and they're all circling the same date, 2026. Not a vague sometime in the future, not a generic warning about eventual risk, specifically 2026. Why? Because multiple economic time bombs, each powerful enough to trigger a crisis on its own, are all set to detonate within the same 18-month window. And when they do, the resulting shockwave could make 2008 look like a practice run. So, what exactly is converging in 2026 that has the world's top economists sounding alarm bells? Why are we facing what some are calling the perfect storm of economic crises? And most importantly, if you've been building wealth, saving for retirement, or planning your financial future, what happens to your money when this storm hits? Are we headed for another great recession, something worse, or could this all somehow be avoided? What do the experts know that most people don't? And why is 2026 the year everything changes? To understand why 2026 is the danger zone, we need to understand what's been building beneath the surface since the last crisis. After the 2008 financial collapse, central banks around the world made a choice. Instead of allowing a painful but cleansing recession, they flooded the system with cheap money. Interest rates dropped to near zero. The Federal Reserve, European Central Bank, Bank of Japan, and others printed trillions in new currency. The goal was simple: prevent economic collapse and stimulate growth. It worked, sort of. Markets recovered, unemployment fell, GDP growth returned. From 2010 to 2020, we experienced the longest bull market in history. The S&P 500 nearly quadrupled. Real estate prices soared. Billionaires multiplied. On the surface, prosperity returned. But beneath that surface, structural problems were growing. The cheap money didn't just revive healthy businesses, it kept zombie companies alive. Firms that should have failed, that weren't actually profitable, survived on cheap debt. When money costs nothing to borrow, even terrible business models can appear viable. By 2019, over 15% of publicly traded companies in the US were zombies. Firms whose earnings couldn't even cover their interest payments. They survived only by rolling over debt at ultra-low rates. In Europe and Japan, the numbers were even worse, approaching 20% in some sectors. Then came COVID-19, and instead of allowing creative destruction, governments doubled down on the same strategy. More stimulus, more money printing, more debt. The US alone printed over $5 trillion. The Federal Reserve's balance sheet exploded from $4 trillion to over $9 trillion. Similar patterns played out globally. This created asset bubbles everywhere. Stocks reached valuations not seen since the dot-com peak. Real estate prices detached from incomes. Cryptocurrency markets ballooned to $3 trillion. NFTs sold for millions. SPACs raised billions with no real businesses. Everything was inflated. And here's the critical part. This wasn't sustainable, and everyone knew it. Central banks said so explicitly. The cheap money was emergency medicine, not a permanent condition. Eventually, rates would have to normalize. Eventually, the debt would matter. Eventually, the bill would come due. That eventually is arriving in 2026. Let's start with the most immediate threat: government debt. The pandemic-era borrowing wasn't just massive in absolute terms, it was also structured with specific maturities. Governments issued bonds, promises to pay back borrowed money, with specific expiration dates, and a huge portion of COVID-era debt matures between 2025 and 2027. The US Treasury has over $7.6 trillion in debt maturing in 2026 alone. That's more than one-fifth of all outstanding Treasury securities. These bonds need to be either paid off or refinanced by issuing new bonds. Here's the problem. When these bonds were issued during COVID, interest rates were near zero. The US government was borrowing at 0.5% to 1.5%. But now, after the Fed's aggressive rate hikes to fight inflation, new bonds must be issued at 4% to 5% or higher. Let's do the math. Rolling over $7.6 trillion at an additional 3% interest cost means roughly $230 billion in extra annual interest payments, just from 1 year's refinancing. And this comes on top of already record-high interest costs exceeding $1 trillion annually. For context, the entire US defense budget is around $850 billion. The government is approaching a point where interest on debt exceeds defense spending. That's a death spiral indicator. And it's not just the US. Japan has over 150 trillion yen in JGBs, Japanese government bonds, maturing in the 2025 to 2027 window. Italy, with a debt-to-GDP ratio over 140%, faces similar refinancing challenges. Even Germany, typically fiscally conservative, issued substantial COVID debt that's now coming due. If any major economy fails to refinance smoothly, global bond markets could freeze, interest rates would spike, governments would be forced to cut spending or print money, triggering either recession or inflation, likely both, stagflation. But government debt is only one-time bomb. Corporate debt is perhaps even more dangerous. During the era of cheap money, corporations binged on borrowing. US corporate debt reached over $10 trillion. Much of it was used not for productive investment, but for stock buybacks and acquisitions. And just like government debt, corporate debt has maturity schedules. According to the Bank for International Settlements, over $1.5 trillion in corporate bonds mature in 2026 globally. Companies will need to refinance at much higher rates. For healthy, profitable companies, this is painful but manageable. But remember those zombie companies? They're in deep trouble. A company that was paying 2% interest on debt can probably survive. That same company paying 7% interest? Bankruptcy. We're already seeing early warnings. Corporate bankruptcy filings in 2023 reached the highest levels since 2010. Major retailers have collapsed. Tech companies laid off hundreds of thousands. And this is before the real refinancing crunch hits. The concern is a cascade effect. When major companies default, banks that lent to them take losses. Those banks then restrict lending to everyone, even healthy firms. Credit freezes. Healthy companies that need short-term loans can't get them. They fail too. Unemployment spikes, consumer spending collapses, the real economy tanks. This is essentially what happened in 2008. But this time, the debt levels are much higher. In 2008, total US debt to GDP was around 350%. Today, it exceeds 420%. There's less room for error, less capacity to absorb shocks. Then there's commercial real estate, which could be the black swan that triggers everything else. The pandemic permanently changed work patterns. Remote and hybrid work aren't temporary, they're structural. Office occupancy rates in major cities remain 30 to 50% below pre-pandemic levels even in 2024. This means office buildings are worth far less than before. A building worth $100 million when fully leased might be worth $50 million at 50% occupancy. But here's the catch. The mortgage on that building was based on the $100 million valuation. Commercial real estate loans, like other debt, have maturity dates. And similar to government and corporate bonds, a massive wall of commercial real estate debt matures between 2025 and 2027, over $1.5 trillion in the US alone. Banks lent money assuming properties would maintain or increase value. Those assumptions are now obviously wrong. When these loans mature, they'll need to be refinanced based on actual current values. That means either the building owners need to inject massive amounts of new equity, money they don't have, or default. We're already seeing this play out. Major office towers in New York, San Francisco, and other cities have been handed back to lenders. The owners simply walked away because the debt exceeded the property value. Small and regional banks, which hold a disproportionate amount of commercial real estate loans, are particularly exposed. Remember Silicon Valley Bank's collapse in 2023? That was partially triggered by bond losses, but regional banks also have huge commercial real estate exposure. If property values collapse further, dozens of regional banks could fail simultaneously. The FDIC insures deposits up to $250,000, but there are over 4,000 banks in America. The insurance fund has around $125 billion. That sounds like a lot until you realize total bank deposits exceed $17 trillion. The FDIC can handle a few small bank failures. It cannot handle systemic regional bank collapse. Before we dive deeper into the other crisis triggers converging in 2026, make sure you're subscribed and notifications are on. This isn't fear-mongering. These are real structural problems that financial professionals are actively preparing for. Drop a comment. Have you adjusted your investment strategy based on these risks, or are you riding this out? Let's discuss what's coming next. Beyond debt and real estate, there's a geopolitical dimension that could serve as the match lighting the economic powder keg. US-China tensions have been escalating for years. Trade wars, technology restrictions, South China Sea conflicts, and the big one, Taiwan. Military analysts and intelligence agencies have identified the mid-2020s as the highest risk period for a Taiwan crisis. China's military modernization will peak around this time. Xi Jinping faces domestic pressures to resolve the Taiwan issue during his tenure. The US is committed to defending Taiwan, at least rhetorically. Beyond debt and real estate, there's a geopolitical dimension that could serve as the match lighting the economic powder keg. US-China tensions have been escalating for years. Trade wars, technology restrictions, South China Sea conflicts, and the big one, Taiwan. Military analysts and intelligence agencies have identified the mid-2020s as the highest risk period for a Taiwan crisis. China's military modernization will peak around this time. Xi Jinping faces domestic pressures to resolve the Taiwan issue during his tenure. The US is committed to defending Taiwan, at least rhetorically. A military conflict over Taiwan would be economically catastrophic even without a single shot fired. Taiwan produces over 90% of the world's advanced semiconductors through TSMC. These chips are in everything: smartphones, cars, aircraft, weapons systems, medical equipment, data centers, everything. A blockade of Taiwan, even without invasion, would halt global semiconductor supply within weeks. Auto production would stop. consumer electronics would vanish from shelves. The economic impact would dwarf COVID supply chain disruptions. But there's a financial dimension too. A Taiwan crisis would likely trigger massive sanctions on China, similar to what happened with Russia. But China's economy is 10 times larger than Russia's and far more integrated into global supply chains. Sanctioning China means sanctioning the world's largest manufacturer, largest exporter, and second-largest economy. Financial markets would collapse. Global trade would freeze. Supply chains built over 40 years would shatter overnight. And remember all that debt we discussed. In a crisis environment, refinancing becomes impossible. Interest rates spike, defaults multiply. The 2026 debt refinancing challenge becomes a 2026 debt apocalypse. Even if war is avoided, escalating tensions create uncertainty. Businesses delay investments. Consumers postpone purchases. Economic activity slows precisely when the debt refinancing crunch hits. Bad timing becomes catastrophic timing. Then there's the demographic time bomb, particularly in China and Europe. China's population peaked in 2022 and is now declining. The working-age population is shrinking faster than expected. By 2026, demographic drag will be subtracting roughly 0.5% from potential GDP growth annually. This matters because China has been the engine of global growth for 2 decades. When China's growth slows substantially, which demographic realities guarantee it will, global demand contracts, commodity prices fall. Emerging markets that depend on Chinese demand suffer. The global economy loses its primary growth driver. Europe faces similar demographic challenges. Germany, Italy, and Spain have fertility rates far below replacement. The working-age population is declining while retirees increase. This creates what economists call the dependency ratio crisis. Too few workers supporting too many retirees. Government budgets come under enormous pressure. Pension and healthcare costs explode while tax revenue shrinks. The only options are cutting benefits, raising taxes on a shrinking workforce, or borrowing more, adding to the debt problems we've already discussed. Japan is furthest along this path and offers a preview. Decades of slow growth, persistent deflation, massive government debt, exceeding 260% of GDP. Japan has avoided crisis only because of domestic savings and the yen's status as a safe haven. Most countries won't be so fortunate. There's also a commodity supercycle concern. Historically, commodity prices move in long cycles, roughly 20 to 30 years up, then 20 to 30 years down. The last major peak was around 2008 to 2011. The trough was roughly 2015 to 2020. Many analysts believe we're entering a new commodity supercycle driven by energy transition demands. Electric vehicles need lithium, cobalt, and copper. Solar panels need silver and specialty materials. Wind turbines need rare earth elements. The green energy transition requires a massive build-out of commodity-intensive infrastructure. But here's the problem. Investment in commodity production has been insufficient. Oil and gas companies were pressured to limit exploration. Mining projects take 10 to 15 years from discovery to production, and few new projects were started in the 2010s. If commodity prices spike in 2025 to 2026 due to supply constraints, it triggers inflation globally. Central banks would be forced to choose between fighting inflation with rate hikes, which exacerbates the debt crisis, or accepting high inflation and destroying currency value. Either choice is economically damaging. We saw a preview in 2021 to to 2022, when oil briefly hit $120 per barrel and natural gas prices in Europe increased tenfold. That was with relatively healthy underlying economies. Imagine similar commodity shocks hitting during the 2026 debt refinancing crisis and potential geopolitical chaos. The combination could be devastating. Let's talk about what this means for ordinary people. If these scenarios unfold, markets would experience significant corrections. We're not talking about a 10 to 15% pullback that happens periodically. We're talking about potential 40 to 50% declines across major indices, similar to 2008, or even the 1973 to 1974 bear market. Your 401k, your retirement accounts, they could lose half their value within 18 months. Someone with $500,000 saved could see it drop to $250,000. And unlike previous crises, there's less ammunition to fight back. Interest rates aren't at zero anymore, so there's room to cut, but not as much. Government debt is already at record levels, limiting fiscal stimulus capacity. Real estate, especially in overpriced markets, could see significant corrections. The Case-Shiller index would likely decline 20 to 30% nationally, with some markets like Austin, Boise, and Phoenix potentially experiencing 40% plus drops as speculative excess unwinds. For homeowners with mortgages below their home's value, this is painful but survivable. But for recent buyers who stretched to afford properties at peak prices, or those who refinanced and pulled out equity, underwater mortgages become reality. Walking away might seem rational, triggering foreclosure waves like 2008 to 2010. Unemployment would rise significantly. In 2008, unemployment peaked at 10%. A 2026 crisis could potentially be worse. Corporate bankruptcies mean layoffs. Startups shut down. Hiring freezes become ubiquitous. Landing a new job becomes difficult. Young people entering the workforce face a brutal environment. If you're feeling concerned about protecting your wealth through this potential crisis, you're not alone. Hit that like button if you want more content on practical strategies for navigating economic downturns. And drop a comment with your biggest question, whether it's about real estate, stocks, or how to position yourself for what's coming. We'll address the most common concerns. Now let's talk about who might actually benefit from this crisis. So who wins if 2026 brings the major market shock experts are predicting? First, cash becomes king. In a deflationary debt crisis, holding dollars or other stable currencies preserves purchasing power while asset prices collapse. That boring savings account, earning 4 to 5%, starts looking brilliant when stocks are down 40% and real estate is down 25%. Sophisticated investors with dry powder will find incredible opportunities. Warren Buffett has been sitting on record cash levels, over $150 billion, waiting for exactly this kind of scenario. When great companies are priced for bankruptcy but aren't actually going bankrupt, fortunes are made by those who can buy. Short sellers and hedge funds positioned for decline will profit massively. In 2008, investors like John Paulson and Michael Burry made billions betting against overvalued mortgage securities. Similar opportunities will exist in 2026 around commercial real estate, zombie corporations, and sovereign debt. Distressed debt investors will thrive. When companies are desperate to refinance maturing debt, specialized funds provide expensive capital. These vulture investors often earn 15 to 20% returns while everyone else is losing money. It's not pretty, but it's profitable. Certain sectors and commodities could be safe havens. Gold historically performs well during financial crises as investors flee to safety. In 2008 to 2011, gold nearly tripled from $800 to $1,900 per ounce. If 2026 brings similar chaos, gold could exceed $3,000 per ounce. Defense contractors might prosper if geopolitical tensions escalate. Lockheed Martin, Raytheon, and Northrop Grumman see revenue surge when governments increase military spending in response to threats. And perhaps counterintuitively, some technology companies could emerge stronger. In every crisis, certain innovations accelerate. The 2008 crisis birthed the sharing economy, Uber, Airbnb. COVID accelerated remote work technology. A 2026 crisis might accelerate AI adoption, automation, or other technologies that help companies do more with less. But the biggest winner might be China, if they navigate the crisis better than the West. If the US and Europe are paralyzed by debt and banking crises while China manages to stabilize, the geopolitical balance shifts dramatically. The dollar's reserve currency status could erode faster. The yuan could gain legitimacy. China's Belt and Road Initiative could expand as desperate nations seek alternative financing. This is actually a strategic concern for Western policymakers. A major economic crisis in the West, while China remains relatively stable, would accelerate the multipolar world order shift. American influence would decline. Chinese influence would expand. The post-World War II order would fundamentally change. So, what are the possible outcomes? Let's examine 3 scenarios. Best case, policymakers get ahead of this. The Federal Reserve and other central banks coordinate. They begin slowly reducing interest rates in 2025. Easing refinancing pressure. Governments implement targeted fiscal support for critical sectors. Diplomacy prevents Taiwan crisis. The debt gets rolled over smoothly. Asset prices decline moderately. 15 to 20% correction, but not catastrophically. Recession arrives, but is shallow and short. This requires exceptional policymaking, international cooperation, and some luck. It's possible, but not probable, given current political polarization and geopolitical tensions. Middle case, controlled crisis. Markets correct significantly. 35 to 40% decline in stocks, 20 to 25% in real estate. Several major corporate bankruptcies occur. A few regional banks fail. Unemployment rises to 8 to 9%. But governments and central banks respond aggressively. Emergency measures prevent systemic collapse. It's painful and takes 3 to 4 years to recover, but civilization doesn't end. This is probably the most likely scenario. It would resemble 2008 in severity, but with different details. Your wealth takes a hit, but the system survives. Patient investors who hold through the crisis eventually recover. Worst case, systemic breakdown. The debt refinancing fails spectacularly. Multiple major banks collapse. Credit markets freeze completely. Corporate bankruptcy cascade ensues. Unemployment exceeds 12%. A Taiwan crisis erupts simultaneously, shattering supply chains. Inflation and recession occur together. Severe stagflation. Social unrest emerges. Political extremism rises. The crisis persists for 5 to 7 years. This scenario, while less likely than the middle case, cannot be dismissed. The debt levels are unprecedented. The geopolitical tensions are real. The structural vulnerabilities are obvious. If multiple shocks hit simultaneously, the system could break in ways that surprise everyone. The critical variable is timing and sequence. If problems emerge gradually, they can be managed. if they cascade rapidly. Debt crisis triggers bank failures, which trigger corporate bankruptcies, which trigger unemployment, which triggers geopolitical desperation. Control becomes impossible. We're approaching the conclusion, but your financial future depends on taking this seriously. Subscribe and turn on notifications so you don't miss our upcoming videos on specific strategies to protect your wealth and potentially profit during the 2026 crisis. Drop a comment. Are you preparing for this, or do you think the system will muddle through somehow? Let's discuss what you can actually do. So what should individuals do? First, understand your exposure. If you are heavily invested in stocks with no cash reserves, you're vulnerable. If you own real estate with large mortgages in overpriced markets, you're exposed. If your job is in a vulnerable sector, retail, commercial real estate, zombie corporations, you're at risk. Build cash reserves. Financial advisors typically recommend 3 to 6 months of expenses. In a potential crisis environment, 12 to 24 months is smarter. Yes, cash loses value to inflation, but it preserves optionality. When assets are cheap, cash is power. Diversify beyond traditional stocks and bonds. Consider gold or precious metals as insurance. Look at Treasury inflation-protected securities. Tips. Explore international diversification. Though carefully given global interconnectedness. Reduce debt where possible. If you have high-interest credit cards, pay them down. If you have investment properties with thin cash flow, consider selling before the crisis hits. Being debt-free provides enormous psychological and financial security during downturns. Invest in skills and education. In economic crises, human capital becomes crucial. People with rare, valuable skills stay employed. Those with commoditized skills face brutal competition. Make yourself indispensable or develop capabilities that travel well across industries. Consider your career strategically. Some sectors will suffer more than others. Tech, finance, and commercial real estate will face headwinds. Healthcare, essential services, and government might be relatively stable. Position yourself accordingly if you have flexibility. Don't panic, but don't ignore. The worst response is either paralyzed fear or willful blindness. The smart response is calm, rational preparation. Make a plan. Execute gradually. Don't try to time the market perfectly, but do reduce vulnerabilities. History teaches that every generation faces its defining economic crisis. The Great Depression shaped our grandparents. Stagflation and oil shocks defined the 1970s. The 2008 financial crisis was millennials' formative economic trauma. Gen Z and younger millennials may well face their defining crisis in 2026. These events are painful but also transformative. The crises force necessary adjustments that should have happened gradually. Zombie companies finally die. Asset bubbles finally pop. Unsustainable debt finally gets restructured. The system resets. And from these resets come opportunities. New companies emerge. New technologies accelerate. New business models prove their worth. The survivors come out stronger. The prepared come out wealthy. The 2008 crisis destroyed wealth for many, but created it for others. Those who kept their jobs and bought stocks in March 2009 saw their investments triple by 2013 and increase nearly tenfold by 2021. Real estate bought in 2010 to 2012 doubled or tripled in value. Crisis creates the best buying opportunities for those with resources and courage. The same will likely be true in 2026 and beyond. Yes, wealth will be destroyed. Yes, suffering will occur. Yes, the adjustment will be painful. But opportunities will emerge for those who prepare, preserve capital, and act when others are paralyzed by fear. The experts are warning about 2026 for good reason. The confluence of debt refinancing, geopolitical tension, demographic pressures, and structural economic problems creates a dangerous perfect storm. The multiple time bombs aren't theoretical, they're real and they're ticking. Will it definitely happen in 2026? Maybe not. Perhaps 2027 or 2028. Perhaps delayed somehow until 2030. But the underlying problems don't disappear through wishful thinking. The debt exists. The maturities are scheduled. The demographics are destiny. Something has to give. The question isn't whether adjustment happens. The question is whether it happens gradually through intelligent policy or catastrophically through crisis. Current evidence suggests crisis is more likely. The preparation window is closing. The storm is coming. What you do next determines whether you're a victim of the 2026 breakdown or one of those who emerges stronger on the other side. Choose wisely.